there is a term in the lending world called DTI. Debt to income, which essentially means how much debt a lender will lend you based on your income. We work out that roughly there is a debt to income ratio of 5 to 6 times income, which means for every $1 of income, we can get $5 to $6 in debt. If you earn $100K, you can expect that the bank will lend you somewhere between $500,000 to $600,000. And you can see that in comparison to the debt it gets you, it doesn't really allow you to get that much. So if it was $200,000 of income, you could probably borrow $1 to $1.2 million. $300,000 of income, you could probably borrow $1.5 to $1.8 million. A really good rule of thumb is to go, well, what am I earning? That can include not just your earned income, but then also investment income from shares or rental income from properties, for example. The bank will lend you roughly 5 to 6 times that amount. But there are other things that come into consideration, right? So when it comes to expenses, a really common one is credit cards. Most people have credit cards. Most people say they pay them down every single month. If we have a $10,000 credit card limit, even though it may be zeroed out every single month, the bank doesn't look at it like that. The bank looks at it that if you maxed out your $10,000 credit card and didn't pay it back at the end of the month, how much would that cost as a monthly repayment? General rule of thumb, for every $1,000 of credit card limit means $10,000 in a decrease of borrowing capacity. So in this example, where we had a $10,000 credit card, it would have a $100,000 impact on serviceability. So if we go back here and we go, well, the debt to income ratio is 5 to 6 times income. So we have $100,000 of income, which gives us $500,000 to $600,000 in debt. But we also have a $10,000 credit card. That means we're going to take $100,000 off this $500,000 to $600,000. So now we can probably only borrow $400,000 to $500,000. You could have other things in there. You may have a car loan, almost finished paying that car off. Let's say you're in the last 12 months. But again, the bank doesn't look at it and says, well, you've only got 12 months to pay the car off. So we'll assume that that's going to be paid off in 12 months and we won't actually assess that. The bank just goes, how much is that repayment? $250 per month, $3,000 a year. They just assume that that's going to be an ongoing payment, which again, smashes your serviceability. We need to be really conscious of how much we earn, how much we spend, and what our expenses look like, because a regular reoccurring expense in the bank size is a bad thing. If you go on a holiday and spend $10,000 or $15,000, for example, that's a once-off expense. As long as that's not as a common thing, the banks won't look at that as having a massive impact on your serviceability. But if you're spending thousands of dollars a month on things regularly, banks will look at that as a living expense, and that will obviously have an impact on your overall net income.